Hey everyone, George here. So if you're a contractor working harder than ever but paying more to the IRS, here's the deal. Retirement accounts aren't necessarily about retirement so much as they are about tax control. And choosing the right one can save you tens of thousands easily, if not hundreds of thousands, while choosing the wrong one can quietly cost you a fortune. In today's episode, we're breaking down which retirement accounts actually save real money and which ones cost you. So let's get started. So if you're a W-2 employee, taxes are annoying. And if you're a contractor running your own small business, they can be absolutely brutal if not planned correctly. You pay federal income tax, state income tax, self-employment tax, and often quarterly estimate. So every extra dollar you earn, the IRS takes 35 to 45% of it. And again, I say that if not planned correctly, properly tax plan and tax strategize, obviously that rate would be much lower. So here's the deal with retirement plan. They exist for one main reason: to delay, reduce, or eliminate those taxes. But not all retirement plans are created equal. Let's start simple, traditional IRA. You put money in, you get a tax deduction, the money grows tax deferred, and you pay tax later when you take withdrawals. So what's the problem with this? The contribution limits are tiny. Income limit kills the deduction for high earners, and it barely moves the needle for contractors making real money. So for most contractors, this is very bare minimum entry-level tax planning when you're in the earlier phases of your business. Next up, a Roth IRA. Sounds very appealing, everybody talks about it. So here's the deal. You pay tax now, the money grows tax-free, and withdrawals are tax-free later. But again, income limits block a lot of contractors, contribution limits are low, and you're paying tax at your highest earning year. Roth IRAs are great for younger or lower income earners, but high income contractors usually not optimal by itself. Next up, the backdoor Roth IRA. If you've heard of the backdoor Roth, here's the clean version. You contribute to a non-deductible IRA, you convert it to a Roth, and now you've gotten around the Roth phase out. But let's be clear, this is a $7,000 move and not a tax strategy worth mentioning. So we move on to the solo 401k, and this is a little bit more high power weaponry. If you're a contractor, sole proprietor, LLC owner, or just a business owner with no full-time employees, this is where the game can change, and the solo 401k can let you move money in two ways: the employee contribution and the employer contribution. So let's take a real example with this. Let's say you net $150,000. So with a solo 401k, you can stash away $24,500 for the employee side for 2026, and for the employer side up to $37,500. So that's $62,000 that you've sheltered for tax purposes. And at a 35% rate, that's about $22,000 that you've saved. So why do solo 401ks beat IRAs? Way higher contribution limits, no phase outs, massive tax deductions, it's still your money, and they could be invested flexibly. You could even control your account and do your investments however you want. This is why high income earners love them once they understand them. So there's a common fear that I need to access my money, but now it's stashed away. So that's a fair point. But keep in mind that a solo 401k allows you to take a loan out of it. So you can take a loan up to 50% of the balance, capped at $50,000. Also, some plans allow real estate investing, and you control the custodian. So this isn't money locked in a vault forever. It's just money protected from taxes while still being usable. Now let's get into the real big guns here. We're talking about advanced tax strategy, defined benefit plans. So if you're making $300,000 or more and you're in your 40s or 50s and wanting to hammer away at your taxes aggressively, this is where the defined benefit plan comes in. So this can allow $100,000 to $250,000 per year in tax deductible contributions. And this is how high earning contractors legally destroy their tax bill. But as a disclaimer, this is definitely more complex, requires steady income, and needs a proper setup. So it's definitely not for everybody, but when used correctly, it can really bring down your tax bill. So what this all means: retirement planning is not about age, it's not about Wall Street returns, it is about tax planning. Most contractors work harder, earn more, and accidentally give the IRS a raise every year. The contractors who win use solo 401ks or defined benefit plans, layer strategies, keep control, and at that point, it really becomes about tax planning and strategizing, about building wealth while minimizing your taxes. And again, this is something we do for a lot of our clients. We do proactive tax planning, not just at the end of the year, all throughout the year. If you are in a higher income earning year and you're worried about your taxes, we're happy to speak. Our calendar link is down in the show notes. Feel free to book a time. We can always run a breakdown analysis of your specific numbers to know which plan can actually fit your situation and to stop guessing so you set this up and do it right. So I hope you found this helpful, and see you in the next one.